I'm Grant Walker. Welcome to Last Call for Tuesday, the 5th of May. I'll be back with Heads Up tomorrow morning at 10. To Auckland house prices. Auckland house prices climbed to a fresh record last month, while the number of sales dropped from March's peak, according to Barfoot and Thompson, the city's largest realtor. The average sale price rose to $804,282 in April, from March's previous record of $776,729. The firm sold 1,070 houses last month, down from March's monthly record of 1,597, but the most for an April month in the past decade. The real estate agency's numbers follow data from Quotable Value last week, which showed Auckland's property values rose an annual 14.6% in April, speeding up from the 13.9% pace a month earlier. The average value was $809,200, according to the state valuer. The Reserve Bank introduced loan restrictions in October 2013 to try to cool the market, and is worried overheated Auckland property prices may lead to financial instability. Barfoot's chief executive, Wendy Alexander, said loan-to-value ratios are materially affecting the sale of affordable homes. Some 157 homes sold during the month went for under $500,000, which represents 1 in 7 of all homes sold. There is a good choice of homes in this price category, but LVRs often mean potential buyers cannot meet the home deposit requirements. Meanwhile, the National-led government has been leaning on Auckland Council to free up land and relax planning constraints to help ease the shortage of housing, which it blames for rising prices. Barfoot said during April, Barfoot had 1,580 new listings with 3,151 properties for sale on its books at the end of the month, the lowest number on offer since January, and a drop of 13% from the same period a year earlier. Aviation news. Air New Zealand's Dreamliner fleet will be grounded every 3 months while technicians check they're airworthy, but the national airline's shareholders do not seem to be concerned about any impact on the business. The US Federal Aviation Administration says testing has revealed Boeing 787s or Dreamliners could lose all AC electrical power after being continuously powered for 248 days due to a computer glitch. If unchecked, this problem would leave crew unable to control the plane. It's ordered operators to completely shut off power to the planes every 120 days during maintenance, while US-based Boeing develops software to fix the problem. The FAA estimates a cost of US $85 per deactivation cycle, which takes about an hour. A spokeswoman says Air New Zealand fully complies with all airworthiness directives from relevant aviation authorities, and this requirement will be incorporated into our ongoing maintenance plans. She declined to comment on whether passengers should be concerned about a mid-flight failure or what impact this may have on opportunity costs. Air New Zealand took delivery of its first Boeing 787-9 airliner in July last year and flew it from Seattle to Auckland. Its 3 Dreamliners fly to Perth, Shanghai and Tokyo, with up to 9 more due to be delivered by 2018. China's Southern Airlines and Chile's LAN Airlines also operate 787s out of Auckland, with about 270 of the aircraft operating around the world. The Dreamliner has been plagued by battery problems since debuting in 2011, including when its fleet was grounded for 2 months during 2013. There have been 2 cases of overheating batteries sparking fires on a Japan Airlines plane in Boston and an all-Nippon Airways jet in Japan. The Dreamliner, which can cost up to US $260 million, is meant to save airlines money on fuel because its body is made from lightweight composite materials. The plane also features bigger windows, larger overhead bins and better ventilation than previously built aircraft. Air New Zealand shares are at $272 and do not seem to be affected by the Dreamliner news. The stock has risen 1.68% today and just under 40% in the past 12 months. To the farming sector, a lower dairy price forecast is not stopping Chinese firm Hunan Dakang's push to buy more Kiwi dairy farms. Shenzhen-listed Hunan Dakang, currently about 55% owned by Jian Zhaobai's Shanghai Pingxin, has signed an agreement to buy 7 dairy farms and 3 support farms in Northland for about $42.7 million. The intended purchase follows several other land deals currently being assessed by the Overseas Investment Office. These include an application for Hunan Dakang to acquire Shanghai Pingxin's interest in Crayfer Farms, a pending purchase of Lochinver Station for $88 million, and the management rights over Pingxin's interest in Sinlate Farms in Canterbury. Other deals include a proposed $22.75 million purchase of a third dairy farm business near Taupo. This latest acquisition sees the Chinese firm look to extend its dairy empire to Northland, where it's buying 3,300 hectares in the Mangakahia Valley district just south of Kaikoui from Mervyn and Karapini. All up, Hunan Dakang's dairy farm assets in this country would amount to more than $500 million. Hunan Dakang announced the deal to the Shenzhen Stock Exchange late last week and has lodged a new application with the OIO. Gary Romano, Chief Executive of Penzhen International, told NBR Radio. He says the acquisition demonstrates the company's commitment to invest in dairy in spite of the low payout forecast from Fonterra. Mr. Romano says it's another case of us wanting to develop what we've identified as an undercapitalised set of farms, while also adding some environmental benefits. So the story is the same for us, he says. Even with the milk payout going down, we're still committed.
NBR Radio with the Property Press. It's out now to show you around.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. ANZ's earnings are out. MSL Capital Markets pays its tax bill. First, naked broadband. Now, naked power. What's the problem with the Dreamliner? And Spark appoints a new agency for its direct marketing. To find out more on these stories, log on to nbr.co.nz or stay right where you are. Those stories coming up next on NBR Radio.
Hi there, I'm John Stewart for NBR Radio on Tuesday the 5th. I'm joined now by NBR News editor Duncan Bridgman. Duncan, you've written about another Chinese dairy farm land buy-up, this time in Northland. Can you tell us about it?
The news broke this morning that Shenzhen-listed Hunan Dakang, which is currently 55% owned by Shanghai Penzhen, has signed an agreement to buy 10 farms in Northland, 3 of which are support farms, but the whole package is worth about $43 million. Now, the vendor is a family called the Pinney family, and they've been farming up near Kaitoki, near the Bay of Islands, for a number of years, and the Chinese investment firm has lodged an application with the Overseas Investment Office to acquire the land, which goes with a number of other acquisitions in recent times.
So what do you think their chances are of getting that OIO approval?
Well, it's complicated, and these things can be complicated, particularly in this particular instance, because Hunan Dakang is listed on the Shenzhen Stock Exchange, as I mentioned. So basically 45% of the shares in that company are owned by retail investors or high net worth Chinese investors who are able to trade their shares freely on the stock exchange up there. And we, NBR broke the story last year that Hunan Dakang was looking to acquire Shanghai Penzhen's assets in this country, and they're a well-known firm that's invested here now, including the Crayford Farms, the controversial purchase of that in 2012 for around $200 million, and also their other assets include a stake in Canterbury farmer Hindley Farms, and also they have an application in for Lochinvar Station, which caught the news last year. Now that particular application for Hunan Dakang to acquire Shanghai Penzhen's New Zealand assets has to go through first, has to be cleared first before these other deals can go through. So that's key, and we won't know about that until May, June this year. And if that goes through, then these other kind of bolt-on acquisitions can be assessed properly.
So quite a few layers. They don't seem too concerned about lower dairy prices, do they?
No, that's right. I spoke to the local chief executive of Shanghai Penzhen, who's Gary Romano, who's ex-Fonterra person actually, but he said basically the story hasn't changed for them. They are confident in the long-term story for New Zealand dairy, and the story out of China for demand maybe hitting a bit of headwinds at the moment, but they're confident in it, and I guess this is a vote of confidence in the dairy sector, if you can put it that way. And also, he's talked about in the past the foreign investment bringing in offshore capital to improve these dairy farms, which across the sector there is a lot of difficulty at the moment with the low dairy payout forecast, and some of these farming entities, groups, have got very high leverage, and they're basically constrained by the debt they've got. So he's talking about improvements there, under recapitalising these businesses, and also adding some environmental benefits, which I guess is a key point they'll be pushing for the Overseas Investment Office.
Bit of a sweetener. Is there any opposition to this Chinese acquisition?
Absolutely. There's a groundswell of debate going on right now. Winston Peters is obviously he's led the charge right through. New Zealand First have been strong on this, and I think everyday New Zealanders are now waking up a little bit to what's happening, and it's not just in the dairy sector either, but other property holdings are being snapped up by Chinese investments and other foreign investors as well. It's not just the Chinese. And there's a lot of perhaps xenophobia, but also a lot of scaremongering perhaps. And the official figures that the government like to talk about only portray a very small percentage of New Zealand land is under offshore ownership now, or applications in for it. But I think the public are concerned that ordinary New Zealanders are sort of being kind of sidelined from owning property here. But
well, I mean, that does beg the question, is there any upside to Chinese investment in New Zealand dairy in particular?
I think to a certain level there is some upside, and that is what I talked about before. I mean, you've got a lot of these farm entities that are smothered in debt, and we've seen some poor practices result in that. The Crayford Farms was a highlight. It was one example, and even in this recent case in Northland, the vendor has had some difficulty with the authorities before on some dirty dairying issues. So that's one thing they'll be pushing. And the other thing is, again, I'd say that it is a vote of confidence in the New Zealand dairy sector, where there are a few structural issues at the moment with Fonterra, but it's something that is positive, I guess.
Indeed. Look, thank you very much for those insights, Duncan.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free, and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
I'm Grant Walker. Welcome to Last Call for Tuesday, the 5th of May. I'll be back with Heads Up tomorrow morning at 10. Business news. Fletcher Building, whose shares have missed the rally on New Zealand's bourse in the past 5 years, has reiterated its forecast for full-year earnings and capital spending to be at the lower end of its guidance range. Operating earnings before one-off items would be at the lower end of the range of $650 to $690 million in the 12 months ending June 30, the Auckland-based Building Products and Construction Group said in a statement, repeating the guidance it gave with its first half results in February. Capital expenditure is expected to be at the bottom of its guidance range of $275 to $325 million. Fletcher shares have barely budged from where they were 5 years ago, achieving a 0.5% gain excluding dividends, while the NZX 15 index has soared 91%. Chief Executive Mark Adamson, tapped for the top job in 2012, has been forced to deal with the high-priced purchase of Crane Group, a downturn in Australia's mining sector, and has been selling assets while embarking on a cost-cutting program and overhauling his management team. In presentation slides for a Macquarie Australia conference this week, the company said residential building consents in New Zealand, its biggest market by sales, were above their long-run trend, and the outlook for commercial construction was encouraging, with civil infrastructure driven by government spending. Residential construction in Australia was expected to remain strong, while the outlook for non-residential work was challenging, with declining investment in the resources sector and uncertainty over government infrastructure spending. Conditions in the North American market were expected to track higher, while Europe was mixed with a weak economic outlook. Further volume growth was seen in Asia, although the Chinese market was increasingly competitive. The company said its performance in 2015 would be affected by the sale of businesses last year and the substantial completion of the Canterbury home repair program. Earnings from its Fletcher Living residential development business were now forecast to be up year on year, it said. A decline in first half earnings partly reflected charges to closed plants and write down goodwill. Its shares last traded at $8.31 on the NZX and are rated a hold based on the consensus of 11 analysts polled by Reuters with an average price target of $9.01. To the Global Mode case. The Global Mode legal stoush could pay off for the media companies, which have included an option for damages in their legal claim. NBR Radio has access to court documents relating to the Global Mode case between TVNZ, MediaWorks, Lightbox and Sky TV and several ISPs and tech company Bypass Network Services. At the moment, how much the media companies want is unquantified, but they've included an option that could include any profit the ISPs and Bypass Network Services made from Global Mode. The statement of claim prepared by Buddle Finlay also seeks an injunction to stop the ISPs and Bypass from continuing Global Mode. The statement alleges breach of the Copyright Act and the Fair Trading Act. It says the ISP defendants are marketing and making Global Mode available to New Zealand subscribers in their own commercial interest. The media companies allege in doing so, the ISP defendants are free-riding off the copyright works to obtain an unfair advantage over their rivals and others who have paid for their content. The statement identifies news releases, social media posts and website pages that promote the use of Global Mode. Specifically, the media companies noted Slingshot had a web page about Global Mode which said it was a brilliant service that lets you visit a range of sites that are normally blocked to people from New Zealand. Slingshot has amended its web page since the claim was filed, although other social media statements referenced in the claim remain online. Banking news. 10 months after initiating negotiations for bank workers, a pay and entitlement dispute between ANZ and First Union will go to facilitation. The Employment Relations Authority process is reserved for when bargaining is unduly protracted and participants have not been able to come to an agreement in mediation. The industrial dispute has involved 8 rounds of collective bargaining, 4 with a mediator, and workers striking across the country. First Union represents about 25% or 1,100 of ANZ's 4,400 employees. Non-union members had their pay increased by 3% in October last year. First Union applied to move the dispute to facilitation, and according to the ERA determination of member Greg Wood, ANZ did not oppose the application. In his decision, Mr Wood says the parties do not even agree on how many issues there are in dispute, although that did not determine the claim. He said it shows major difficulty in the bargaining if the parties cannot agree on what matters they are in dispute over. Facilitation is an Employment Relations Authority process in which a facilitator helps provide a process and problem-solving technique. The facilitator may then make a non-binding recommendation. First Union spokeswoman Maxine Gay says the parties will meet next month. Ms Gay says the issues include pay, flexible hours and how particular salary bands are interpreted. ANZ spokesman Stephen Herrick says the bank will fully cooperate in the process. She said we have made a very good offer of 3% and 2.75% pay increases over the next 2 years at a time when the cost of living has only increased by less than 1% in the last 12 months. He says flexible work arrangements will only be imposed on some new employees in ANZ's branches. The last high-profile employment dispute to be moved to facilitation was the Ports of Auckland dispute with the Maritime Union, which concluded in February after 4 years. Maritime Union National President Gary Parslow told NBR Radio facilitation was a waste of time, and the parties spent about a year just having meetings.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
Hi there, I'm John Stewart for NBR Radio on Tuesday the 5th. Sally Lindsay and in Christchurch, Chris Hutching are our property experts and they join me now. Sally, what's caught your eye?
Well, this morning we just got a press release from the ex-former Fletcher Building Chief Executive Terry McFadgen saying that he wants to have mediation over the Cornwall Trust Board and their new leases. The Trust Board has offered new leases at 7 years and a couple of incentives, but the Leaseholders Association say they offer no freeholding mechanism, so the leases are actually no good and in the end will cost the 110 homeowners who live on the Cornwall Park Trust leasehold land more. it'll be interesting to see whether mediation goes ahead. I don't think Cornwall Trust Board will agree to this because they've spent a lot of time coming up with this new lease, and they seem to be slightly arrogant about the way they've gone about the whole business. The leaseholders are having to put up with terrible situations. For some of them, their ground rent payments went from $8,000 a year to $70,000 a year under their 21-year Glasgow leases. These leases have all been got rid of by other trust boards, and they've actually freeholded their residential properties and invested money in commercial property, bonds, cash, and other forms of investments, and are actually making better returns. So I don't know why Cornwall Trust Board wants to hang on to these old-fashioned leases and not freehold the land, because they would, in the end, make far better returns and be able to plough more money into Cornwall Park.
So do you think it's bound for court?
No, I'm not sure about that, but there are a couple of retired judges on the Cornwall Trust Board, apparently, who could easily conduct the mediation and get all the parties around the table and try to come to some sort of agreement, because nobody is going to apparently sign the new 7-year lease. So Cornwall Park Trust Board is stuck with what they've got.
The old between a rock and a hard place.
That's exactly right. So something needs to give. So,
Chris, in your area, what's been happening?
Okay, from the South Island, we had a story yesterday about the EQC involved in a court case. Now, this court case was over costs. What occurred was there were 3 couples actually, or 3 families involved in this case against EQC. Now, they had assessments from EQC, which they thought were way under the value, and they got their own experts. After a lot of argy-bargy, EQC changed their mind and agreed that the repairs or rebuilds were worth an awful lot more than what they said. And when I say an awful lot more, you know, they were talking sort of figures around 100,000, and the final claims end up sort of closer to 1 million. So these are massive discrepancies. Anyway, after they changed their mind and said, yes, we agree that these repairs are worth a lot more, the people who had been trying to take them to court said, okay, we want some court costs off you. And EQC tried to argue, well, actually, no, you didn't really win a court case. We had a whole lot of argy-bargy before, and we changed our minds, so you haven't won a court case, so you can't have costs. Now, the appeal court said, well, you know, this is wrong, because they did have to engage in initial court activity, and more importantly, they've said it's a precedent for many other cases, and there are a number of other cases, a lot of cases I haven't actually counted the actual number in the last couple of months, but when I last did a count, it was over 100 cases wending their way through the courts against EQC. I think it's kind of the legacy of EQC 4 years ago, being an organisation that had about 20 staff, and then suddenly we had the Canterbury earthquakes, and they had to gear up to have more than 1,000 staff. I think it's a reflection of the quality of some of those people, not all of them, but some of those people, and it's come home to roost. However, EQC at this stage, the senior executives of EQC and the lawyers must take a greater responsibility for this kind of ongoing court action. I mean, for goodness sake, you know, we're 4 to 5 years after these earthquakes now, and they're still fighting these crazy court cases. So hopefully this will be a precedent setter, and it might discourage EQC from taking frivolous court action. It's, in the end, it is basically taxpayers' money in the long run.
Would it be too cynical to say that the only people who will really, at the end of the day, benefit from all this are the lawyers?
Well, yes. You know, sometimes, more than sometimes, often, you look at these situations and you think, you know, where is the advisor somewhere in this organisation who can give a little bit of wisdom? Because the lawyers don't. I mean, the lawyers are after the business. The lawyers want to be active. More often than not, the lawyers want to naysay most things. You need a a chief executive or a senior administrator with wisdom to be able to say, what is the wider picture in this? And, obviously EQC doesn't appear to have that.
And Sally, anything else in the property world that you've had in your sights?
Yes. Well, last week the council came to an agreement or a compromise with Ports of Auckland on only building one wharf and the smaller of the two wharfs. So immediately the cruise industry said, well, it will be cancelling the big mega ships that are being built around the world from coming down here. The first Royal Caribbean's Ovation of the Seas was supposed to arrive here at the beginning of 2017, but with the smaller wharf it won't be able to berth. Neither will any other ships of that size. And Ports of Auckland has been berthing Queen Mary at Jellicoe Wharf, but it says it can't leave that wharf open for 5 days every time these big mega ships come down here. So that's going to cost the economy of Auckland quite a lot of money. These ships bring a lot more passengers. The really big ones, which are rumoured to be coming here in the next couple of years, bring 6,000 passengers at a time, which is a lot of money to be spent in Auckland, especially when they do tours and they go out and visit shops and all that sort of stuff. So it's going to be interesting on how the cruise industry copes with that, because they say if the ships can't come to Auckland, they just won't come to New Zealand at all, because we're the only transfer port. Auckland is the only transfer port in New Zealand where passengers disembark and board.
Actually, right. Sally, this is an interesting story that has some ramifications down here in Canterbury too, because at the moment we have a similar kind of argument going on where people want our port company to spend not hundreds of millions but tens of millions on new jetties to accommodate these cruise ships. Now, we've had alternative sets of information about the value of these cruise ships. One of them, of course, is the old positive, yes, they spend zillions. The other tells us actually they don't spend a great deal. And in fact, a lot of their facilities on board, like their hotels, cafes and things, are possibly better than what they'd find on shore. So we have a situation here where they can come into Akaroa, which is a tiny town. It can't really deal with them in terms of the infrastructure. Some of them get on buses, come across to Christchurch and Canterbury and do the odd tourism thing. But the port company here is resisting it quite strongly because they say that it just doesn't stack up. Now, you're in Auckland, a bit closer to the situation there, but I'm sure that there are probably some counter-arguments there about alternative uses for the port and whether or not these ships really do stack up, because I think we have to admit that the port company in Auckland is playing politics over this, and this is a really good ploy to say, oh well, you don't want these wharf extensions, look at all the business you're missing out on. So they may be correct, but
it is a reality. It is a reality here, Chris, that they can't berth these big ships. They've got bollards at Ports of Auckland that can only take 80 or 800 pounds pressure. For these big ships, they need 1,500 pound pressure, and unless you can build a wharf that can take those bollards and is long enough, the ships can't come here. It's as simple as that.
Are we talking about cargo ships as well?
Yes, big cargo ships won't be able to come here as well, and it just boils down to that.
That said that actually there could be a lot of other alternative uses for your port, which would bring in billions and billions of dividends to the council that might not involve port trade activities.
Yes, that's correct. I mean, if you look at selling off the port, well, yes, you could. But where would it go? You've still got to deal with all that cargo and all those cars, which people seem to hate, but most of them stay in Auckland anyway. So where do you put it? You've got to put the port somewhere.
Well, we'd better wrap it up there, Sally and Chris. Many thanks.
NBR Radio. Free to air online. NBR, the meeting place of intelligent business.
In market news, an Inland Revenue application to liquidate MSL Capital Markets, which felt the FMA's bite in March, has been withdrawn. The FMA issued a formal warning to the Wellington-based company for failing to report on its anti-money laundering and countering financing of terrorism risk assessment in November last year. In March, NBR Radio reported Inland Revenue had also filed an application in the High Court at Wellington in January seeking the liquidation of MSL. The claim was originally heard on March 31st, but was adjourned for a payment plan proposal to be considered and then again for it to be paid by today. Today, the matter has been withdrawn with no issue as to costs. An MSL spokesman says the matter was settled with Inland Revenue about 3 weeks ago with all tax due paid. Earlier in March, the FMA issued its formal warning to MSL for failing to provide the report by November 28, but added the company had now taken action to undertake the audit and provide the FMA with a copy. The Anti-Money Laundering and Countering Financing of Terrorism Act requires a reporting entity to ensure its risk assessment and AML CFT program are audited every 2 years or at any other time at the request of the relevant supervisor. An FMA spokesman confirms the report has now been provided. JP Morgan Chase Bank's New Zealand branch was also given a formal warning by the Reserve Bank in March for a 4-month period in 2013 when it didn't have appropriate risk assessment measures in place to meet the Act. To the electricity sector. A new electricity retailer has entered the already crowded market, promising to be the cheapest provider. Electric Kiwi joins more than 20 electricity retailers, although the big five, Meridian, Mighty River Power, Genesis Contact and Trust Power, who are also the major generators, dominate, claiming about 95% or more of the retail electricity market. Electric Kiwi's managing director Julian Cardos says the largest of the second-tier companies have only between 50,000 and 100,000 customers, and most are tiny. Mr. Cardos says although about 60% of customers now have smart meters, the major companies aren't offering them the opportunity to use that smart technology, which measures actual energy usage every half hour to minimise their power bills. He says Electric Kiwi will not only offer the cheapest prices, but will also allow its customers to choose one of 2 hours each day, either between 2 p.m. and 3 p.m. or between 10 p.m. and 11 p.m., during which all their power will be free. Mr. Cardos says his company will be able to afford this as it will be paying low wholesale prices during those 2 periods. Although a lot of consumer behaviour won't shift, people will still want to shower in the morning before work and they'll want to eat dinner in the evening. A reasonable amount of power usage is discretionary, such as running dishwashers, washing machines or appliances that can be set with timers, such as heat pumps. Mr. Cardos says if you turn on the appliance for that free hour, you can get that power for free at a time when it's cheaper for us to buy that electricity and save money. That will incentivise consumers to change their behaviour. Electric Kiwi won't be requiring its customers to sign contracts, to pay connection or break fees. It won't run call centres and it won't issue estimated meter readings. Instead, it will be offering what it calls naked power. Just about all customer contact will be online, although customers will be able to phone either Electric Kiwi or the appropriate lines company in emergencies. And Mr. Cardos says in exceptional circumstances, his staff will pick up the phone and deal with whatever the problem is. The company's customers must have smart meters, and so far it has arrangements with 5 of the 29 lines companies that cover about 70% of the population. The areas where it will operate to begin with are Auckland, including the North Shore, Hamilton, the Coromandel, Thames, Tauranga, New Plymouth, Palmerston North, Whanganui, Manawatu, Wellington and Christchurch. Mr. Cardos says his company aims to extend its offering to the more rural areas of the country as the penetration of smart meters increases. But Electric Kiwi won't be offering special below-the-line promotional deals, other marketing gimmicks or such things as prompt payment discounts. Mr. Cardos says his company analysis suggests companies offering below-the-line deals are doing so at a loss, and Electric Kiwi will need to operate profitably. Mr. Cardos says we're going to give you our best price up front and we'll give you an hour of power free. Electric Kiwi has had customers since December, but is only now formally launched. Let's talk controversy. Co-authors of a controversial Massey University paper on dairy's zero-sum gain for New Zealand are standing by the paper in the face of mounting criticism from their academic peers. NZ Dairy Farming, Milking Our Environment for All It's Worth, was written by 3 staff at Massey University's Institute of Agriculture and Environment and published 10 days ago in the US scientific journal Environmental Management. According to one co-author, senior lecturer in ecology and zoology, Dr. Mike Joy, the analysis revealed that for the worst-case scenario, using the limited number of impacts valued, the costs to society are approximately equal to the export revenue and GDP. In other words, the industry is a zero-sum gain for New Zealand if the costs are included. The paper's abstract describes the paper as the first nationwide assessment of some of the environmental costs of the recent increase of dairy intensification in New Zealand. But neither it nor the media release mentions that the paper is drawn entirely from selective data taken from only 1 year, 2012. The paper's national cost estimate for selective dairy farming impacts on New Zealand has a lower limit of $2.1 billion and an upper limit of $15 billion. Although the lead author was Massey research technician Kailisha Foote, who completed a Master's in Environmental Management there last year, this is not made clear on the media release. Her comments do not appear on it, only Dr. Joy's do. Academics such as Waikato University agribusiness professor Jacqueline Rowath and the head of research at the New Zealand Initiative, Dr. Eric Crampton, have criticised the research, leading Dr. Joy to ask why such detractors haven't done their own assessment of externalities of dairy. Now, for more on this and further reaction, go to nbr.co.nz.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
Hi there, I'm John Stewart for NBR Radio on Tuesday the 5th. I'm here with court reporter Victoria Young, who has the latest on the Global Mode case, which 4 big media companies have brought against internet service providers and tech startup Bypass Network Services. Victoria, what's the latest development in this saga?
Well, we here at NBR have obtained the Statement of Claim, which is the sort of initiating court document of this case between MediaWorks, TVNZ, Lightbox and Sky TV against Call Plus, which owns Slingshot, Flip, Orcon and Bypass Network Services. Just in a nutshell, I guess, this case is about whether the use of Global Mode, the service which lets consumers sort of pretend they're in a different country so they can watch other TV shows, is legal. And so by obtaining the Statement of Claim, we're able to see a bit more into what the big media companies are alleging.
So what's in the Statement of Claim?
Well, there are many allegations. Obviously, when lawyers prepare these statements, they aim for more, they grasp for as much as they can go for. But the 2 things that we've found interesting here is that the media companies have included an option for damages as well as the injunction to just stop the action, and this could be an account of profits from those internet services providers and Bypass, which means someone would have to calculate how much money they made by having Global Mode. The second quite specific thing that we've noticed is that in the Statement of Claim there's a reference to Slingshot's website about Global Mode, which says that Slingshot claims Global Mode is a brilliant service that lets you visit a range of sites normally blocked to people from New Zealand. And so what we've noticed is that since Slingshot has received a Statement of Claim, it's amended its website. So while, there are a lot of claims and a lot of other social media statements referenced in the claim and they remain online, it sort of suggests to us that perhaps there could be a bit of a back down since they've, altered their website once this claim has been filed.
So what are the experts saying about the claim?
Well, I had a quick chat this morning to Baldwin's partner, Paul Johns, who's maintained throughout this that there's an arguable case for the big media companies. He says while the essence of the claim has been sort of well signalled in the initial legal letters and all that hoo-ha, there is one part of the claim which he's seen now that lacks a bit of detail, I guess. What the lawyer's saying is that the secondary infringement claim, now this is the claim which relates to how, well, I call it the aiding and abetting claim, but I don't know if wouldn't call that the legal way to describe it, but it's how these internet service providers helped the consumers access the copyrighted works. He said that there's usually more detail, and what he told me is that by not spelling this out, perhaps indicates that what the big media companies are doing are not trying to alienate people by directly accusing them of being the end users of copyright and copyright infringers. It's quite interesting.
Indeed. So what's going on with the defence?
Well, we haven't heard much from the defence, and rightly so, because the next step for them is to prepare their case and deliver it to the court. So that will happen in about a month's time. But what I can tell you is that the lawyer for the internet services providers, Rick Shearer, he's come out saying he will vigorously defend the case, and he's now briefed in Queen's Counsel Jim Farmer, which is a bit of a very highly regarded litigator.
He's a real heavyweight.
Yeah, he is. So. And obviously, I think we've previously reported that Julian Miles is on the side of the big media companies. So,
Two heavyweights,
yes, indeed. And of course, Bypass Network Services, they've hired a separate lawyer, barrister David Marriott, and they've said they'll file their defence at the end of the month. So that's what we know to date.
Thanks for that, Victoria.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
To the Aussie OCR. The likelihood of the Reserve Bank of Australia cutting its interest rates today is high, according to punters. But the parity party is over, with the New Zealand dollar unlikely to break the parity mark against the Aussie. CMC Markets trader Sheldon Slabbert says he's pretty confident the Reserve Bank of Australia is going to cut rates at its meeting today. He says, I think the push in the currency markets and the Aussie dollar up to the 80-cent mark against the US was something that was certainly not welcome, and it probably gives them a bit of elbow room to make a cut. He expects rates to be reduced to 2% and will need a bit of time to flow through the economy before another cut is made further down the line. TD Securities Rates and Strategies analyst Prashant Nyunaha agrees the RBA will announce a cut in its official interest rate to 2% today. Since the surprise rate cut in February, the RBA has hinted another cut is in the pipeline, and with no changes in the March and April meeting, May has looked a near certainty for weeks. Last month, the markets were shocked when Reserve Bank Governor Glenn Stevens failed to cut rates. This put a damper on the parity party, causing the New Zealand dollar to fall against the Aussie. Although the Kiwi regained some value against the Aussie in the weeks after, it never ventured over the parity mark. Mr. Slabbert says, and it won't get there today either. Capital Economics Chief Australasian economist Paul Dales is more hawkish in his outlook. He says, although it's not a done deal yet, he expects the RBA to cut rates today, but also stop short of calling parity. He says a recent string of better-than-expected economic data from Australia will factor into the RBA's decision. Mr. Dale says the rises in retail sales in both January and February suggest real consumption may have risen by more than 1% quarter-on-quarter in the first quarter. But he says the chance of a cut is greater than not. The RBA's rates decision is to be announced at 4:30. To the financial markets, the Financial Markets Authority has approved exemptions for smaller investment managers who provide discretionary investment management services, or DIMS, meaning they don't have to prepare and lodge audited financial statements that comply with generally accepted accounting practice. The exemptions come after the FMA in March sought feedback from small and medium-sized DIMS providers on proposed changes, saying audited financial statements may result in limited benefit to clients, while imposing additional costs that may greatly outweigh the benefit. A DIMS provider is one whose client has authorised them to make buy and sell decisions about their portfolio without needing to check back with the client. The most infamous DIMS provider was Ross Asset Management, whose manager David Ross perpetuated New Zealand's biggest Ponzi scheme and is now serving time in jail. Under the exemptions, which apply with immediate effect once granted, licensed DIMS providers with less than 100 million in retail funds under management won't need to lodge GAAP-compliant audited accounts, although they're still required to keep accounting records and meet any other company and tax reporting requirements. Licensed DIMS providers with 100 million to 250 million retail FUM are exempt from having their financial statements audited, but they still must be lodged and be GAAP compliant. FMA General Counsel Liam Mason said under DIMS, the main protection for investors is that their assets are held either by themselves or by an independent custodian who is subject to audit requirements. Applications for DIMS licences must be received by May 31st, the FMA said.
NBR Radio with Baileys, New Zealand's leading commercial real estate company.
Hi, I'm John Stewart for NBR Radio on Tuesday the 5th. A row is taking shape over the effects on our waterways of dirty dairying, with some academics critical of a Massey University report. Reporter Jamie Ball is with me. Jamie, who did the report and what does it say?
The lead author of the report is Kalisha Foot. She's a Massey research technician. She had done a master's last year in Massey University, and the co-authors are Dr. Mike Joy and one other man at the Massey University Institute. What it says is that the national cost for selective dairy farming impacts on New Zealand has a lower limit of 2.1 billion and an upper limit of 15 billion, which it claims equates to a zero-sum gain in the worst-case scenario for New Zealand. That's what it says on outline, but when you look beneath the bonnet, it says something quite different.
And what would that be?
When you look beneath the bonnet, you'll see that the methodology does not add up to making such a sweeping statement. The pieces do not effectively equate to the greater amount. And what I mean by that is the data has just been selected from one year, 2012, and it's just select data. Now, there's a few other factors that go into the mix that haven't helped. Dr. Mike Joy was on the media release rather than the lady Kalisha Foot, so we didn't initially know that she was the lead author. So it's actually hard to actually ascertain that information as to who was the lead author initially, because a lot of this information went into Kalisha Foot's thesis, for her work, her student thesis last year. So I spoke with Dr. Mike Joy about this. That worst-case scenario is being greatly disputed by experts, certainly like Dr. Eric Crampton from the New Zealand Initiative, as well as Professor Jacqueline Rowath.
Primarily, we're talking here, aren't we, about nitrogen leaching from dairy farms into the waterways? Yes. The main critics are Dr. Jacqueline Rowath.
And Eric Crampton as well from the New Zealand Initiative. And it concerns effectively the methodology. I think one of the chief concerns also is that at nowhere in the abstract or the media release is it actually specified that the data collected comes singularly just from one year, 2012, which is of course now 3 years ago. When I initially contacted Dr. Mike Joy, I had asked if data had been collected over the last 10 years, which would be, I don't say usual, but common at least, some sort of establishing a trend line to see how that trend has gone over the last 10 years. But was surprised to find that the analysis comes just from 1 year, 2012. And the input factors into that total amount, that worst case scenario of 15 billion, is also questionable in itself, which our article goes into, and especially with Dr. Eric Crampton's criticism of it and how he would perceive it should be done.
So this argument's got a way to go yet?
Yeah, a long way to go. I don't think it's something that's going to be finished anytime soon. In fairness to Massey University and Dr. Joy, he describes it as a mammoth task trying to collect that data over the last 10 years, and I think in fairness it is. So I guess the question coming out of this is somebody should be collecting this data and somebody should be compiling it in a more accurate, cohesive fashion, but who? Should it be down to Massey University or somebody else? So perhaps that's where the next base is for this article.
Well, many thanks for that, Jamie.
NBR Radio. Free to air online. NBR, the meeting place of intelligent business.
Advertising news. Spark has selected Clemenger Group-owned Proximity for its direct marketing account, spelling the end to an 8-year partnership with DDB-owned Wrap. Proximity will work alongside sister agency Touchcast, Spark's digital agency. The move comes as Proximity shakes up its leadership team, pinching top talent from overseas. Spark General Manager of Customer and Capability, Summer Ormond, paid tribute to Wrap, saying it played a crucial role in Spark's rebrand and has delivered highly successful campaigns in broadband, mobile and SME. Wrap Managing Director Robert Lim says it's a hard loss, but it's simply a break in our relationship. He offsets the loss by adding that Wrap has taken on projects from Air New Zealand and Westpac in the past 2 months. Ms. Orman says the Spark brand is now embedded since rebranding from Telecom. She says this means using digital technology to totally reimagine the customer experience we offer, an experience that should be both effortless and inspiring. This new focus, she says, will require a more joined-up digital and data solution to work with internal technology teams, and so has led to us to review our supplier mix. The combined capabilities of Proximity and Touchcast will allow Spark to harness the power of data and digital in truly innovative and agile ways. Both the Clemenger Group and DDB are owned by Omnicom. According to Nielsen Rate Card, Spark spent $65 million on advertising last year, while Vodafone spent $55.2 million. Another story that keeps on giving, back to the wharves. Cruise liners port agency ISS Mackay says the industry will go backward for at least 3 to 5 years, given Ports of Auckland and its owner Auckland Council's compromise on building only one wharf extension. ISS Mackay Managing Director Craig Harris says the last-minute forced compromise is no compromise, as there is nowhere to berth the longer mega cruise ships expected in Auckland Port from the beginning of 2017. New generation cruise ships come out every 5 years or so, and if Aucklanders strangle growth of the city's wharves with politics and don't want the bigger and longer cruise ships in port, they won't come here. Mr. Harris says the cruise industry wasn't consulted about this debacle, and it would have been good if it had been. Cruise ships, he says, bring 225,000 visitors to New Zealand every season. If they don't come, it will have a huge impact. We want to build the industry and the economic contribution it makes to the country. Royal Caribbean Cruises had planned on bringing the new 348-metre Ovation of the Seas to Auckland, but will drop New Zealand from its itinerary until its next cruise scheduling round in 3 to 5 years. The biggest cruise ship to visit Auckland could have berthed at Jellicoe Wharf at a pinch, says Mr. Harris, but POAL says it cannot keep the general cargo wharf clear for 5 days each time it's in port. Mr. Harris says the new extension is certainly too short, so unless the longer extension is built at some time, the mega cruise ships will never come to Auckland and probably New Zealand, as the city is the only transfer port for departing and boarding passengers in the country. Half of the boarding passengers will stay in Auckland overnight. The ship, carrying 4,900 passengers and 1,300 crew, is the same size as 12 Airbus A380s arriving at the same time. Mr. Harris says the visit could have been worth up to $40 million to New Zealand's economy. All the cruise line industry, he says, is asking for is an infrastructure upgrade. Auckland International Airport, which the council has shares in, made it happen without fuss by widening runways and building bigger air bridges when larger A380 planes were introduced into fleets worldwide. If Auckland Council had agreed to the ports company building the longer 98-metre extension, bollards taking 150 tonnes of pressure could have been installed to berth the mega cruise ships. POAL's wharves have bollards that take 80 tonnes of pressure and can't hold the new liners. Mr. Harris says the mega cruise ships want to come here and wanted to start making bookings within the next few months.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
Hi there, I'm John Stewart for NBR Radio on Tuesday the 5th. Chris Keel is with me to talk about a new government website where you can upload your own flag design. Chris, what sort of response is it getting?
It seems to be getting a lot of response so far, but I'm not sure if it's all quite what the government intended. So we have this flag consideration panel, which was established earlier this year with Rod Drury, Julie Christie, various sports people and some academics on it. And they've got down to business today launching a website called standfor.co.nz. And it was pre-populated with a number of comments from people saying what they stand for. And we've got a lot of feel-good stuff: harmony, freedom, natural beauty, animals, opportunity, friends, family, All Blacks, innovation, smiles, and so forth. But as soon as the word got out there, as Rod Drury hit social media and solicited some responses, a whole flood came in, but a whole bunch of them are quite negative. We've got one saying, I stand for not squandering money and keeping the existing flag, and another saying, spend the money on earthquake repair.
Right, so it's got its naysayers by the sound of things.
It does. I mean, I think it's great that they've opened up the website to social media comments, but it again shows both the perils and opportunities of engaging with social media, and there's definitely some contrary opinions coming in.
And you wonder also if there's some traffic along the lines of, hang on a minute, let's make the first referendum whether we indeed change the flag.
Yeah, it'll be interesting to see. As things stand, we've got the first referendum coming, starting November 20, where people will be asked to rank 4 designs, which will be selected by this flag consideration panel with Drury, Christie, the sports people, and so forth. And then a second referendum where the preferred design will be run off against our existing flag. But yeah, perhaps this flood of negative comments on this website may have a useful purpose and make the government think twice.
Chris, thanks very much.
To the banking sector, Australia and New Zealand Banking Group's New Zealand division, or ANZ, reported a 1% increase in cash profit as impairment charges on its commercial lending book offset wider margins from an expanded home loan portfolio. Cash profit in New Zealand increased to $605 million in the 6 months ended March 31st from $601 a year earlier. Of that, the lender's residential business reported a 4% gain in cash earnings to $238 million, while its commercial division posted a 2% decline to $368 million. Net interest income advanced 6% to $1.24 billion. The bank recognised a $20 million impairment charge on bad debts compared to a $37 million gain a year earlier. New Zealand Chief Executive David Hisco said in his review the individual credit impairment charge increased 53%, reflecting a slowing in the level of write-backs, particularly in the ComAgri portfolio, partly offset by lower levels of new and top-up provisions. The release from collective provisions was $49 million lower due to portfolio growth and reduced rate of improvement in credit quality compared to the March 2014 half. The Australian parent reported a 5% gain in cash profit to $3.67 billion Australian dollars, with a 6% increase in net interest income to $7.14 billion. The bank posted a 3% gain in statutory net profit to $3.51 billion Australian, and its board declared an interim dividend of 86 Australian cents, up from 83 Australian a year earlier. The bank's New Zealand unit built its loan book by 6% to $99.52 billion as at March 31st from a year earlier, while customer deposits rose 11% to $61.43 billion. Its net interest margin rose to 2.52% from 2.49% a year earlier and above the group's 2.04% margin. ANZ's New Zealand residential loan book increased 1% to $37.37 billion, lagging behind the 6% gain in its ComAgri loan book to $37.6 billion and a 12% rise in its small business banking to $24.54 billion. The bank's New Zealand business is in talks with the First Union, which represents about a quarter of its workforce of pay and entitlements. The New Zealand unit shrank its full-time equivalent staff by 2% to 5,090 in the half from a year earlier, while the wider group increased its FTEs 3% to 51,243. ANZ's Global Wealth Unit, which incorporates the bank's funds management businesses, reported a 13% decline in cash profit from New Zealand to 62 million Australian, which included a 26 million cross-border settlement on an insurance claim in March last year. The bank's funds under management in New Zealand grew 32% to 17.04 billion Australian, while its in-force insurance premiums advanced 13% to 199 million Australian in New Zealand. The dual-listed shares rose 0.4% to 34.85 on the NZX and have increased 3.6% this year. In business news, broking firm Forsyth Barr says expect double-digit earnings per share growth overall from the upcoming reporting season for companies with March 31st balance dates, although the results will be skewed by a couple of the larger companies. The broker's investment strategist Brian Stewart says it's the smaller of the reporting seasons, with only 22 companies posting results, and the large property companies Kiwi and Argosy will be producing per share earnings falls because they'll be paying tax again. Forsyth Barr estimates underlying growth for the 6 property companies reporting is best measured by the expected 3.2% growth in dividends. It's predicting 4 of the 6 will lift their dividend payouts. Among the other majors, Z Energy will probably lead the pack with the terms of per-share earnings growth, and Mr Stewart says the petrol retailer won't see any operating leverage because of the fall in oil prices. That means Z is more of a volume story, which should be good. Analyst Andrew Harvey-Green is forecasting Zed's annual net profit will be about $134.4 million and a solid lift in the dividend to 25.7 cents a share. Fisher & Paykel Healthcare should produce solid per-share earnings growth, but the company's underlying growth is being distorted by currency effects. Mr. Stewart says to expect the company to have gained market share with its new masks for treating obstructive sleep apnea. Analyst Chelsea Ledbetter is forecasting annual net profit of about $109 million. The perennial performer Ryman Healthcare's result will probably be another strong one. Analyst Jeremy Simpson is forecasting net profit for the year of near $134 million. However, Stewart says Ryman is facing more competition now as well as rising land prices. Notwithstanding the favourable demographics, Ryman's development margins could come under pressure and, due to the timing of demand, it could face some soft periods. Don't expect Mainfreight's result to be too flash after the company's forecast in March of a maximum profit increase of 7.2%. Mr. Stewart says the logistics company is facing some margin pressure in the near term, which will show through in these results and possibly in the next. However, longer term, Mainfreight is a positive story with particularly good growth prospects in the United States. To milk futures, New Zealand whole milk powder future contracts weakened this morning as traders pulled back their expectations heading into tonight's global dairy trade auction, where New Zealand's biggest dairy export product is expected to post its fifth successive price decline. The current May whole milk powder futures contract last traded at US 2280 a tonne on the NZX, a discount to the US 2380 a tonne winning price at the last GDT on April 15, suggesting the price will decline at tonight's auction. The June WMP futures contract slipped US 30 a tonne to 2300 in morning NZX trading. The July futures fell US $10 a tonne, while the August futures dropped 15 a tonne. The September figures slipped US 20 a tonne to 2540 a tonne and is still priced at premium to the 2495 at the last GDT auction. Whole milk powder average prices on the GDT platform have fallen by a quarter over the past 2 months, with the futures market picking further declines ahead. Global demand for dairy products is tepid due to softer demand in China, the world's biggest importer of dairy products, and Russia. Meanwhile, a weaker euro is making production from the region more competitive as low international grain prices stoke production in the Northern Hemisphere ahead of the start of the New Zealand dairy season. OMF Financial Markets Director Nigel Brunel said whole milk powder futures went to a premium to the GDT. They've gone back to a discount, so the futures curve is picking that GDT will fall this time. It's still suggesting a bit of weakness. Skim milk powder futures also fell in morning trading, suggesting a decline in GDT prices tonight. Exports of milk powder, butter and cheese, New Zealand's largest export commodity group, dropped 13% in the year through March to $13.04 billion, according to government figures published last week. Also last week, Fonterra, the world's largest dairy exporter, cut its forecast payout to farmers for the current 2014-15 season to $4.50 per kilogram of milk solids from $4.70, citing an oversupply in international markets and volatile commodity prices. The Auckland-based co-op is expected to provide its forecast for the upcoming 2015-16 season following its May 27 board meeting. The New Zealand milk production season spans June through May, with peak production in the spring months covering September through November, with a couple of months lag for production before the product is sold.
NBR Radio with Hotel de Brett, your home away from home, but with better service. NBR Radio.
Hi there, I'm John Stewart for NBR Radio. The level of immigration the country can absorb is now viewed largely in the context of Auckland housing prices. But there's also a wider economic debate, and Australia is considering what a visa or passport is really worth and whether they should be sold. In his Editor's Insight for Tuesday, Neville Gibson examines the arguments. Neville, what's a passport really worth?
Well, this is not a new issue, and several countries have examined it and what it's worth for people to move there. Several years ago, the US economist Gary Becker, who's now dead, was a keen advocate of selling passports and visas as a market-driven solution to immigration in America, which of course is a huge issue. And he calculated that a US citizenship was worth around about $50,000, and he said in any year when they have about 1 million immigrants wanting to go to the United States, you'd be able to spend $50 billion on social services, schools and hospitals and the like. And in the EU at the moment, where there's a lot of indebted countries such as Greece, Portugal and Cyprus, well, they'll sell you a passport for as low as $100,000, mainly to Russian financiers and that sort of thing. And it's also quite widespread in small islands around the Caribbean and even, I might say, Tonga, where Russian and Chinese money basically will buy you citizenship of some sort.
Has this been studied in New Zealand?
Not the sale of passports, but work's been done on the benefits of immigration, and it's never as simple as it seems. Mostly we think there's a benefit from having a larger population, but if you dig down into the Treasury archives, you find that they actually say there's more of a net cost than a benefit, but obviously over time, the more the population, there are wider benefits, but they haven't actually put a price on what it would cost.
Does this make it viable to sell citizenship rather than the current system of measuring skills and the like?
Well, that's what we do at the moment, thinking that will yield the bigger benefits, and certainly those skills do deliver those because we don't have to pay for education and so on. But not all migrants have these skills, and when you take into context the wider family, for most of them they actually get a net benefit that goes largely to them, while the community waits quite a while for any benefits to come through. But there's no doubt that putting a market price on the cost of living here would be quite a boon for the government.
Does this system, has it been used anywhere else?
Not really, though the idea, as I say, is not new. Australia is certainly studying the system, and last year the idea of selling citizenship was raised in the UK by a committee headed by Professor David Metcalf, and NBR covered that quite extensively at the time. And many of these desirable countries, New Zealand, Canada among them, run investment schemes, and essentially that's what it was. That is, you sort of say if you want to come here and invest in a business. But these are not so popular. In fact, they've been a complete failure in New Zealand because they can mean that you have to put $1 million into government bonds or go and set up a business in Westport or Napier or somewhere, and people have avoided those.
So you say Australia has been looking into it. Where are they actually at?
Well, in March, the Treasurer, Joe Hockey, ordered the Productivity Commission there to investigate the matter, and they've just in the past few days issued an issues paper called Migrant Intake in Australia, and it weighs up the greater use of charges compared to quotas and the skills-based system. Some of the figures are interesting when you consider just what Australia's migration level is. They have about 190,000 places, and we're complaining, we're down in the under 50,000, and that's not even the net figure. And that's mainly made up of skilled visas, but there's also nearly 14,000 who come in as refugees and others and humanitarian one. Looking at the costs, the Immigration Department says it earns around about $1.7 billion from selling passports and visas and other things. But the costs of all these immigrants into Australia is about $600 million, but the issues paper and some politicians in Australia are keen on making it into a money business, say that you could get between $10 billion and $15 billion a year. So that's what Australia is looking at.
Neville, many thanks.
NBR Radio. Free to air online with business news you can use.